Welcome everyone. In today's video, we're going to be taking a look into the 5 most interesting DeFi projects coming to Arbitrum. Now that Arbitrum has become the 6th largest chain in terms of TVL, now is the perfect time to start digging into the new stuff being built there. And with that being said, the first project I wanted to speak about is Vertex Protocol. So Vertex Protocol combines 3 different things: perpetual futures trading, spot margin trading, and a money market. With some of the long-time viewers here, this should sound familiar. It sounds exactly like Mango Markets, which is on Solana. And Mango Markets was an excellent app before it got exploited. And so I expect something similar to Mango Markets from Vertex Protocol. And so you should be able to execute some interesting basis trading strategies, as well as long various different things without having to KYC. And you will also have cross margining as well as being able to use this as a kind of money market. And so I expect Vertex Protocol to be sort of integrated into all of the yield aggregators out there on Arbitrum as well. And so I'm really excited for this. I'll definitely be doing a review when it eventually comes out. Now, the second project I wanted to talk about is Carapace Finance. So Carapace Finance does something unique. I've actually not seen this before. So basically, you're able to provide money to under-collateralized loan protocols with protection. So effectively what you're doing here, you can earn yield by providing capital to cover default risk in under-collateralized loans. So you have various different under-collateralized lending protocols out there. And what you're doing is you're providing insurance to those under-collateralized protocols in case the loans that they've given out to various different counterparties actually go bad. Now, it depends on whether or not you believe that, these loans are risky or not. You have Goldfinch, True Finance, other places like that who will provide under-collateralized loans to like market makers, for example. And market makers tend to be safer than, say, hedge funds when actually giving them out loans. And in the case that they don't default, you earn insurance premiums for doing so. And so this is quite interesting. Now, the next project I wanted to talk about is Contango. So Contango is bringing expirable futures to DeFi. So you'll be able to trade linear and inverse contracts. Another interesting thing about Contango is that every position is tokenized as an NFT. Now this brings, a few benefits. So you're able to sell that NFT to someone else. So you're able to transfer that position without the need to update Contango's internal accounting. So you can sell this in the secondary market or a private market, which is quite cool. Additionally, it enhances composability, as Contango positions could potentially be used as collateral in a third-party protocol. And this is what we like to see from DeFi, more composability, more optionality for people out there if you want to generate further yield upon your positions. And then just going down further, in terms of settlement, Contango offers physical delivery, as this process is not vulnerable to price manipulation. So there aren't that many protocols out there actually using physically delivered futures. If we just look here, in terms of DeFi, it's mostly perpetual futures, and in terms of CeFi, it's mostly perpetual futures as well. And the next project I wanted to talk about is Rysk Finance. So they're offering dynamic hedging vaults. So what you'll be able to do here is sell option premium, and they will use spot trading and perpetual futures in order to target market neutrality. So the problem with decentralized option vaults is that crypto is very volatile, especially to the upside or the downside. And if you're selling a covered call, for example, it's typical for that covered call to get completely blown out, because say you're selling a covered call on the price of Solana and the strike price is 15% above the current price of Sol. Sol can easily rally that much in a day, right? And so the dynamic hedging vault enables you to still earn that yield from selling the covered call, but then prevent you from getting wrecked on the upside. Now, the next project I wanted to talk about is Y2K Finance. So Y2K Finance is an interesting one. So effectively, it allows you to buy insurance on depegged assets. So this is how it will work. We have a MIM vault here. And we have 2 parties. We have one party that believes MIM is going to depeg to at least 99 cents in a week time. And then we have another party here who believes that's not going to happen. And so if you believe that MIM is going to depeg, you are a hedge depositor. And so the hedge depositors deposit ETH into this MIM vault, and then they receive a token saying that they've deposited into this vault. And then we have the risk depositor. So these are the people who believe that MIM is not going to depeg, and effectively they are underwriting insurance for this person. So they deposit ETH into the vault and they receive a token saying that they've deposited into this vault. And so at the end of the week, if MIM doesn't depeg to 99 cents, they receive all of these guys' deposits as well as their initial ETH as well. And so effectively these guys are insurance underwriters and these guys are buying insurance, and then any fees generated here goes to the Y2K treasury. And then in the case that a MIM actually does depeg and it goes below 99 cents, then the hedge depositors, so these guys who buy the insurance, they get paid out whatever these guys actually deposited in. And so most of the time, you're going to make money by being the Rysk depositor. But in that one situation where you believe that MIM is going to depeg, or if you just wanted to buy insurance and have safe of mind if you're doing some sort of leverage yield farming using MIM, then it makes sense to become a hedge depositor. And in fact, someone recently made a ton of money by betting on MIM depegging. So Digits DAO made 99.52 ETH on this trade through Y2K Finance. So they bought insurance. They believed that MIM was going to depeg, which was a good trade. I believe most of the MIM collateral is FTT, and FTT has dumped massively in the past week, and then MIM depegged slightly, and then they got paid out a massive amount of money. And the last project that I wanted to talk about today is Rage Trade. So I've spoken about this more in depth in a video on my channel, so I'll leave that in the link in the description down below if you want to check this out. But Rage Trade is an ETH perpetual futures DEX here on Arbitrum, and they're looking to become the most liquid ETH perpetual futures DEX in crypto. Now they're looking to do that by unifying omni-chain liquidity. So you'll be able to take ETH USD positions, money market LPs, other derivatives, DeFi positions as well, and then deposit that into Rage Trade where it'll be used as recycled liquidity. Now there's about $50 billion in ETH USDC TVL out there, and if Rage Trade is even able to take a fraction of that, it should become one of the best places to trade ETH perpetual futures in crypto. So thank you for watching. I hope you enjoyed this video. Make sure to check out all of these 5 projects. I'll leave links in the description down below, and make sure to subscribe for more videos like this one.